So today we'll be talking about the merger and acquisition of Quantum Corporation by Akamai. Quantum Corporation is a hardware manufacturing and also supplier to governmental agencies such as NASA, the Federal Reserve, and also the Federal Bureau of Investigation. The acquisition for the reason is that Akamai is running a lot of expenses on hardware and also depreciation. Therefore, we thought that an acquisition of Quantum Corporation would look very good in order to help increase the shareholders' earnings and also increase the efficiency of the working capital and also improvement of the dependency of Akamai on other suppliers and also other supply chain factors that could impede during, example, a pandemic or also a supply chain shortage of semiconductors. So therefore, we thought that this project would look very good, and also it is forecasting and also giving back a very good returns of an NPV of 209, also an IRR of almost 30%, and also an MIRR of almost 20%.
In our models and forecasts, we're using an 18% annual growth. And how we arrived to this number? We arrived to this number by doing a comps analysis, where we took into consideration the biggest and most important and most relevant acquisitions in the tech industry. So an example is Lenovo when it acquired IBM that generated a 238% growth. This is clearly an outlier, but it shows how profitable acquisitions in the tech industry are. Another example is Ericsson and Vonage that generated a 20% growth. Then we have the Twilio and Segment acquisition that generated 5% growth, Intel and Mobileye that generated a 30% growth. All of these are really important because they are similar to Akamai and Quantum. They represent the technology that we want Akamai to acquire. Another thing that we took into consideration is the premium price. As in every acquisition, when a company is acquiring another one, the buyer is almost obligated to pay a premium price to the shareholders of the company that they're buying. In our M&A, our premium price has been calculated by using an average of the past premium prices that has been used in the tech sector. The premium price that Akamai would need to pay to acquire Quantum Corporation is around 29%. This would result in a total acquisition cost of $462.66 million, or 7.8 per share.
After talking about the premium price and previous acquisition analysis, we will talk about the cash flow analysis that we did in order to calculate the forecasted figure post-acquisition. In order to do the cash flow analysis, we have decided to calculate the previous year growth percentage and then average the previous 3 years in order to forecast the figure, as it can be seen on the picture on the slide. On the next slide, we can see that in order to have a realistic scenario, we have also decided to add in revenue growth of 18% and a cost reduction of also 18%. This number were taken by conducting an analysis of the past acquisition that occurred in the tech market. This giving us an average of what will happen to the revenue and to the cost. The same concept can be also found on the WACC calculation on the next slide. When calculating the WACC, we have decided to take an average of the required rate of return. This to reflect the fact that with the acquisition, Akamai would increase its market share, and this might have a direct effect on the expenses of the company, thanks to the economy of scale. Another important aspect to point out is the fact that we have taken in consideration an average tax rate return of just Akamai. This because Quantum was never able to present a profit to its shareholders. Now I will pass the words to Carolina.
We were able to find the NPV taking into consideration the forecasted cash flow from the acquisition. Walking through the numbers, the acquisition cost of $462.66 million comes from acquiring Quantum at a premium price of 29%. In this case, Akamai purchases and operates their credit line, so taking total assets minus accumulated liabilities, we arrived at $33.8 million. Initial revenues forecasted as $477.35 million. As Leslie already explained, the variable costs of 46.42% as percentage of revenue forecasted by taking the average of both companies' income statement. The initial fixed cost of 151.3 million were taken from both companies' forecasted income statement, and as for initial total expense of 376 million, we're taking from our forecasted income statement on both companies, and the inflation rate is one of the most challenging estimations. However, we estimate a 5% inflation rate being conservative, that it won't go back to pre-pandemic levels, and not expecting hyperinflation. The discount rate was adjusted according to Quantum's beta, since Akamai's WACC doesn't hold the same risk as Quantum. Calculating the average of both betas resulted in 18.35%, and the same logic for the receivables we used to forecast figures of Quantum income statement to find the receivables as a percentage of sales totaling 19.96%, inventory of 21.77% as a percentage of next year's cost, by doing a forecast on Quantum balance sheet and income statement to understand what is the inventory turnover. And lastly, the tax rate of 10.17% was estimated by using Akamai's estimation, since Quantum does not pay taxes at the moment.
So for the scenarios of Akamai's future, we chose 3 different outcome scenarios. First one is with expectations of a 10% revenue decrease with no further cost reduction over the period of 6 years. Second scenario is with a 30% revenue increase, followed by a scale of cost going down with 20%. Now, last scenario taken into consideration is if we were to expect another COVID-19 lockdown. Here we would expect a 15% revenue decrease, followed by a slow growth on the second, third and fourth year, where variable cost would be going down with 15% and fixed cost would go down with another 20%. Now, as a corporate action in the past, we considered the announcement of the $1.8 billion worth of share buybacks announced in November. Now, the reasoning behind the share buyback was to pursue flexibility on dividends to shareholders, market condition warrants, and also liquidity to strategic investment opportunities. Now, if we were to look at the shareholder benefits, we can kind of identify 4 different ones. So first one, improved shareholder value as the EPS will increase. Then, of course, secondly, boost in the share price due to the positive change in earnings per share. Thirdly, as cash is being used to buy back shares, the shareholders actually gets a capital gain taxation, which gives them a tax advantage, since it's a much lower taxation than the ordinary income tax rate. Now, the last and fourth thing is when a company repurchases its own shares with excess cash, it gives you a pretty clear picture that this company is doing really well and you're expecting to get dividends in the future. Thank you.